Good morning, members. This is the fourth session for case studies for the registered valued exams. You can go through all the previous three case studies through the similar videos. The link will be available in the description or in our channel. So let's start with the fourth one without wasting any time. So this fourth case study is also very one of the typical case studies and important one also for the exams. So many times asked in the exam. So let's start this. In this particular case study, what was happened actually? One equity index was framed, and for framing of that equity index the last 5 years data was used of the companies who were those were surviving on the date of making of that particular index. Say for example, last 5 years data of only those companies are used which were surviving, or those were surviving on the date of preparation of this index. So that means the companies which started operating during these previous 5 years, but due to their negative returns or falling losses, they have closed down their business. They were not be available while framing this index, and due to the same, their negative returns are not considered while framing this index. Hence, the index returns by default, those will be upwardly biased, because the negative returns of the stocks which are closed down or which companies are closed down during these 5 years are not considered. Secondly, during a time period of 2004 and 6, there were some war-like situations or negative adverse situations due to which the economy was adversely affected. So if you use economy is adversely affected due to wars, in future that is not going to be there. So if you use that type of situation while calculation, that war type situation you will consider, and you use the market expectation based on the return generated by the index during that situation. So if you use that, obviously the market return will be lower in wars, etc., and market returns will be lower, then the expected risk premium will also be lower. So the risk premium will be downward biased in that situation. More than that, it is asked something that a Boston chain for the application of calculation of risk premium. It is asked that a Boston chain formula that is to be applied, the information regarding to that is given. 1 plus real Boston chain, sir, 1 plus real GDP growth rate, 1 plus earning growth rate, 1 plus PE growth rate, minus 1 plus the index dividend yield, and minus risk-free rate is called risk premium under a Boston chain. So all these data, five items are given in the next part, and it is given that the short-term bond yield, that is risk-free rate yield, is 9%. The long-term bond yield is 7%. So if you use the short-term bond yield for future expectation, then obviously you are using a upward biased return. Then if we go to the questions, then the inclusion of index return prior to 2001 would, as I just discussed, that if you are not using the loss making companies, you are only using the equity risk returns of the company surviving on 2001, then this will definitely bias your returns, bias the historically equity risk premium upwards. Then events of 2004 to 6, that was a war-like situation, would be expected to bias the historical equity risk premium estimate downwards, because during that war-like situation the returns would be a bit lower, and if that returns will be a bit lower, obviously the risk premium based on that returns will be lower. In the current interest rate environment, using a required return estimate based on the short-term government bond rate, short-term government bond rate was 9%, and historical equity risk premium defined in the terms of short-term government bond rate would be expected to, if short-term bond rate is 9%, they are using that for required rate of return, then obviously this will be a long-term growth rate is bond rate is 7%. So this will definitely bias your long-term required rate of रिटर्न ऑन इक्विटी एस्टिमेट अपवर्ड्स. अगर आप 7 की जगह पे 9% रेट यूज करोगे तो उसके प्रोपोर्शनली जो रिस्क प्रीमियम आएगा दैट वुड बी हायर, एंड इफ दैट वुड बी हायर द रिक्वायर्ड रिटर्न विल बी biased and also the upwardly biased. Now fourth, I discussed the formula. I'm repeating that a supply side estimate of the equity risk premium as presented by Boston Chen earning model is closest to 1.04, 1.05, 1.01 given in the question, minus 1 plus the dividend yield of the index, and minus RF, that is 4.3%. Risk premium it is calculating. You have to remember this formula, but all information will be provided in the exams. So this will be 4.3%. Now it is asking that common stock equity, so stock issues in the above market with an average systematic risk are most likely to have a required rate of return. The required rate of return is the RF plus risk premium that we desire generally. So in this particular case, the RF for short term funds is 9%, for long term funds is 7%. So if RF is 9 plus 7 and we add something risk premium in calculated over here also, we have calculated 4.3% at least. So if we add this, then the required rate of return would be, even use long term RF or short term RF, it will be at least 9% or more. The last part of this is based on leverage of beta. We have discussed in the sessions also so many times that whenever the debts are involved, leverage is involved, the proportionate risk on equity shareholders start rising. So it said that which other statement is most accurate? If two equity shares have the same market risk, the overall beta or overall risk is same, but the first issue has higher leverage. If this is having higher leverage, greater liquidity is a better factor that is not going to increase your expectation, increase your risk profile for the equity investor. And a higher required return, the higher required return is most likely the result of the first issues greater liquidity. Greater liquidity will not affect your expectation, but higher leverage, due to higher leverage, higher equity beta will be there. Higher equity beta will be there. Putting that beta in CAPM, you will get the higher expectation of return. The correct answer is higher leverage. Let's revise the 6 parts. If you are using the if you have used the data of not used the data of the loss making companies while framing the index, the equity risk premium will be upwardly biased. And during the 4 and 6 there was war, so it was downward biased. Equity risk premium was downward biased. It said that in spite of 7% of long-term RF, you are using 7% RF, you are using 9% RF of a short term, then the long-term required rate of return of equity will be upwardly biased. And Boston Chen is there. Then expectation of return will be RF plus at least risk premium. And sixth is which can increase your expectation of return or required rate of return. Obviously, if the risk factor will increase, and if the overall beta is same, but if their security is having higher leverage or entity is having higher leverage, then it is going to increase your expectation of return. This is it for the day. Please revise all the 4 or all the 3 other case studies also. The links will be available.